When Bitcoin first appeared in 2009, it wasn't pitched as an investment. There were no price predictions, no talk of digital gold, and no promises of getting rich. Instead, it came with a revolutionary idea: money that belonged to everyone and no one. The early Bitcoin community wasn't thinking about portfolio diversification or hedge strategies. They were chasing something far more radical: a peer-to-peer currency outside the control of governments and banks. For the first time in history, you could send value anywhere in the world instantly, without permission from any institution. No bank could freeze your account. No government could debase your savings. No payment processor could censor your transactions. And this wasn't just theory. In 2010, the famous Bitcoin Pizza Day saw 10,000 Bitcoin exchanged for 2 pizzas, worth about $40 at the time. Nobody cared about future returns. They just wanted to prove the system worked. Bitcoin's promise was liberation, access for the unbanked, stability for those living with collapsing currencies, a way for small businesses to bypass credit card fees. It was money for the people, by the people. A financial system that would level the playing field. That was the promise. But 15 years later, has that promise really been kept? Let's start with some uncomfortable facts. Blockchain analysis shows that a tiny percentage of Bitcoin addresses, often linked to early adopters and large exchanges, control the vast majority of all Bitcoin. In other words, wealth in Bitcoin is more concentrated than wealth in most developed countries. And the concentration isn't just financial. It's demographic and geographic too. In the United States, surveys show Bitcoin ownership is overwhelmingly male, about 3/4 of holders. The average investor is disproportionately white, college-educated, and above median income. Globally, most Bitcoin trading and ownership happens in wealthy regions: the US, Europe, Japan, and South Korea. Meanwhile, in places where Bitcoin's promise might matter most, sub-Saharan Africa, Bangladesh, much of South America, adoption is still minimal. Then came COVID. From 2020 to 2021, Bitcoin's surge overlapped with massive government stimulus and a new wave of retail speculation. Millions of Americans received stimulus checks, sometimes larger than their usual weekly income, and with lockdowns giving people extra time, many funneled part of that money into markets. Surveys show that nearly 1 in 10 Americans put stimulus funds into crypto. And Federal Reserve research confirms that trading volumes in Bitcoin spiked right after payments were issued. But while stimulus helped fuel retail excitement alongside meme stocks and Dogecoin, the bulk of Bitcoin's rally was also driven by ultra-low interest rates, institutional investors, and corporate balance sheet buys like Tesla's. This wasn't organic growth based on Bitcoin's utility. It was speculation fueled by government cash. And today, the loudest Bitcoin voices aren't neutral observers. They're people with enormous financial stakes. When tech billionaires, politicians, or even the Trump family launch Bitcoin funds and predict astronomical prices, they're not just analyzing, they're marketing. Here's the irony. Bitcoin was supposed to decentralize financial power. Instead, it risks creating one of the most concentrated forms of wealth we've ever seen. If Bitcoin hits the sky-high valuations its promoters predict, the biggest winners won't be the unbanked or the poor. There'll be a tiny group of early adopters, venture capitalists, and tech elites, the same people who already had disproportionate power under the old system. But Bitcoin advocates push back on these criticisms. And some of their arguments deserve to be heard. Supporters argue that every new technology starts this way. The internet was once the domain of academics. Cell phones began as luxury items. Even the stock market was once only for the rich. Early adopters take risks. Broader adoption comes later. Others highlight Bitcoin's accessibility. Unlike real estate or private equity, you can buy $10 worth of Bitcoin just as easily as 10 million. The network runs 24/7 with no brokers or minimums. In theory, a farmer in Nigeria has the same access as a hedge fund manager in New York. And some investors, even cautious ones like Ray Dalio, see Bitcoin as digital gold. They argue it's still early in a decades-long monetary revolution. Just as billions eventually got online, billions might eventually hold Bitcoin. Advocates also point out that Bitcoin provides something traditional finance can't: an escape valve from central bank money printing. Even if you only own a fraction of a coin, you've got access to a system that no government controls. Finally, there's the network effect. Every early user helped prove the technology. build infrastructure, and create the global liquidity that makes Bitcoin useful today. In that sense, outsized rewards for the earliest participants aren't unfair. They reap compensation for taking the biggest risks. These are serious arguments, but they raise new and troubling questions about what Bitcoin is becoming. Bitcoin advocates aren't wrong. Early adoption is usually concentrated. Accessibility is better than in many traditional assets. But here's the difference. The internet, cell phones, and even stock market spread because they provided clear, everyday utility. People went online because email made life easier, not because they hoped to get rich. Bitcoin's main driver today isn't utility. It's speculation. And speculation behaves differently from technology adoption. There's another problem: correlation. For years, Bitcoin was sold as an independent alternative to traditional finance. Yet in practice, it now moves in lockstep with risky assets like US stocks. When the Fed raises rates, Bitcoin falls. When markets rally, Bitcoin rallies too. So if Bitcoin just tracks the system it was meant to replace, what's the point? Even if you accept that early adopters deserve rewards, the scale is staggering. If Bitcoin ever reaches $1 million per coin, the wealth concentration would be unprecedented. A handful of holders controlling sums rivaling entire national economies. And let's not forget the participation gap. The belief that gives Bitcoin its value is not global consensus. It's the belief of a narrow demographic: young, male, tech-savvy, and mostly Western. That's not universal adoption. That's a niche group with disposable income. For Bitcoin to live up to its original promise, a few things need to change. It needs to be used more as currency than as a speculative asset. Adoption has to spread far beyond the wealthy and the Western. Its price has to decouple from Wall Street. And its biggest holders need to prove they actually want democratization, not just bigger yachts. Because right now, Bitcoin is at a crossroads. It began as a tool of liberation. Today, it risks becoming a new engine of inequality. The technology itself works exactly as designed. But technology doesn't shape society, people do. And whether Bitcoin becomes a tool for freedom or just another mechanism of concentration depends less on code and more on us.